Hey, Carla. Yeah, that music is, go get it. Yes, welcome. Welcome, Carla. Am I on mute still? If I have myself on mute. Just gonna give people a little bit to join. Welcome, folks, on Instagram. We're going to be going live soon with Ebony Smith and Brenda Wyatt with our monthly HouzEd series. So welcome, welcome. We're going to get going here in about 2 minutes. Welcome, folks, on the live on Instagram. We'll be underway in a few minutes here. Today, we're going to be talking about mastering the mortgage maze. We're here with Ebony Smith, Realtor extraordinaire, and Brenda Wyatt, our amazing mortgage broker. We're going to be talking about housing and how you can purchase your own property, how you can get a mortgage. So we're really excited about today. Ebony, would you
like to just start with a welcome for the folks that are on time.
Yes. I like the idea.
You are on mute.
Hey, Brenda, I was trying to see if you shared your screen. I have too many screens open. Did you share your screen already?
Yes, can you see my screen, everyone?
Yes, welcome. We can see the beginning slide.
Thank you.
I can't see anything. Hold on.
Oh, that's weird.
That's a little, let me just. Oh, because it was a little screen on my screen. Okay. That is. Oh. Zoom. Hi, everyone. Welcome to the HouzEd Monthly Series presenting Mastering the Mortgage Maze with Brenda Wyatt and Ebony Smith. And next. Thank you all for coming out on Dr. Martin Luther King's birthday. We appreciate you spending your holiday afternoon with us. We want to recognize that Dr. Martin Luther King was a fair housing champion for racial justice and took action by co-leading the campaign to challenge discrimination in employment, education, and housing. The Fair Housing Act was introduced in 1966, thanks to pressure from Dr. Martin Luther King Jr. and other civil rights leaders. Okay. The HouzEd series agenda workshop begins. The welcome introductions and agenda, workshop etiquette, presentation of the Mastering the Mortgage Maze, announcements, and closing remarks. So we can start with the welcome. I'm Ebony Smith. I'm a realtor with Proxima Realty, and also the creator of the Housing You bi-monthly workshops that will be taking place. The first one is today, and the next one will be in March. Brenda?
Hi, I am Brenda Wyatt with LaSalle Mortgage. I have been in the business and a top producer for approximately 15 years now. I focus my business with first-time home buyers, and I am looking forward to sharing how you can buy a house and some programs that can help you with that. Ebony, we cannot hear you.
I just mute myself. Sorry about that. I was going back to the workshop etiquette. Sorry. Just for people here that are here and those that are watching, well, mainly those that are physically here. If you use the reactions, the play chimes or shared hands or recognized hand gestures. If you want to raise your hand and have a question throughout the presentation, please do so. If you have any questions, you can also feel free to put them in the chat. So Housing You, I think I said this already, is a free bi-monthly workshop series designed to educate the community on housing-related matters around laws, policies, homeownership, leasing, and advocacy. For more information, go to housingyou.co.com. So we're going to get started. Sorry. So what's up with the real estate market? This is a question I think most realtors get asked the most. And literally it depends on your situation and also seasonal and economic shifts. And what I mean by seasonal economic shifts, there are several factors that go into play. On a global level, it's currency exchange rates and political climate. We're in election year 2024. On a national level, it's interest rates and inflation, which we all are experiencing currently. And on a city level, it's population, job growth, household income. And on a city level, it's more so about neighborhood dynamics and housing prices. So the challenges we already know we have is low inventory and location, right? We don't have as many homes on the market currently, and also certain locations people are desiring are not available because people are not selling their homes, the sellers. Affordability factor. Wages are stagnant, which we are very much aware of and feeling it. The cost of living has increased over the past year and a half and may even continue to go up a bit. That also causes an issue. And then there's zoning pro-anti housing laws and groups called NIMBY and YIMBY and the housing element. NIMBY is not in your backyard. And YIMBY, as you can guess, is yes, in my backyard. These political groups are one, NIMBY are against building housing in certain neighborhoods, their neighborhoods, due to maybe their perception that it may decrease their property value. They may not want certain groups in their communities. And YIMBY is for those are, we need housing, so we should build housing. So yes, please do build more. We need more people, we need to increase our community. And so with that, California has the housing element where every county has a specific amount of housing that needs to be built in a certain period of time due to the fact that we have more people than housing. And also groups are advocating to change the zoning laws in certain areas so they can build different types of housing, such as single family homes, multi-family homes. Those are duplexes, triplexes, and so on and so forth. If you have any questions, please raise your hand. I'll put them in the chat. The benefits of owning the home you live in. Control. It's your house, psychologically and, of course, legally. And that's something we all want. Investment, relatively simple to understand. I look at it as a lifelong or at least 30-year plus piggy bank. You can pull out equity as it grows in your home, and also you can do other things with your home as well. Tax savings, deductions, and property taxes. Yes, you did get those benefits in tax deductions. You can write off certain things like I have a home business, so I get those are write-offs for me in my home that I own. Stability, predictable monthly payments. You don't have to worry about your mortgage going up every month or every year or whatnot, increase and be different. When you're renting, your rent can go up depending on your landlord, either every year, twice a year. It really depends. It's not really stable, right? You don't know, you can't predict it. And it's based on your landlord's need actually for his or her own property taxes or whatnot, or life changes. So therefore they may raise the rent on you. Appreciation, upside, it's yours, you can keep it. Like I said, it's a huge piggy bank, right? A lifelong piggy bank, and you can have that, enjoy the appreciation on your home, which is what we all want. And that's the whole purpose of owning a home. One, you can't be forced out, and two, you can get that appreciated value. Brenda?
So I will talk about when to buy. Now, when to buy is a personal and individual decision, but some of the factors to consider when you are thinking about if it's time to buy is, are you ready to settle down? It's best to purchase a property when you plan to live in the property at least 5 to 7 years. You want to take advantage of unpredictable income and expenses. So meaning that you don't plan to relocate, you expect that your job will remain the same, and you've looked at your budget and you can afford the monthly payments. You want to understand the financial benefits and risks, which we will go over in our presentation today. And you have some savings. While we will focus and talk about down payment assistance options, which will assist you with down payment and closing costs, you do want to have savings because as an owner, the maintenance is your responsibility. So you want to have, and it's recommended that you have at least 3 months savings when considering buying a property. So as you start to work with your agent, some of the factors that you will consider is, do you love the home? Can I stomach the monthly payment? And will I live here for at least 5 to 7 years? And the 5 to 7 year rule is around the expense associated with purchasing a home and being able to realize some equity if you need to sell the property.
Sorry, Brenda, can I say something about that?
Yes.
I think it's important to not just if you're gonna live in the home for 5 to 7 years, but you could also consider if you're gonna hold the property for 5 to 7 years. So, there's a potential where you might get a job transfer or whatnot, but you can always rent out the property, work out some other sort of arrangement. So I think it's really that you would keep ownership of the property. We're moving so much now with work and other things that are going on that it's really an opportunity to think of this as an investment as well as your residence. Thank you.
Thank you. Great point. Risk of owning the home that you live in. Again, you have to be prepared for repair and maintenance costs. As a first-time home buyer, it is common that you will have a home warranty that can assist with some maintenance issues that come up that first year, and you can always renew the home warranty, but you do need to pay attention to the specific items that are covered with the warranty and be in position to pay any maintenance costs above and beyond the warranty. Values don't always rise in the short term. And so while we're in the Bay Area and we have strong appreciation rates, you want to work closely with your agent, your realtor, to understand what the appreciation rates are in the neighborhoods that you're considering. You might not be able to sell quickly. So as we mentioned in a previous slide, if for some reason you need to sell the house in a short period of time, you'll need to consider the cost associated with that. You never know what could happen. There could be illness, jobs. So the great thing about the Bay Area is that it's pretty feasible to rent out your property. So for some reason, if you do need to move on or you have an emergency situation, you do have the ability to rent rooms or rent the entire property itself. Now, while we don't often see downturns in our market, it is a possibility. And then miscalculation or deceit and fraud, and there are some protections for that, but it is a risk of buying. Now, I am a mortgage lender, and so therefore I am working directly with the bank to review your file to determine if the bank will lend to you. So we do a full analyzation of your credit, your income, and your assets. So the first step when applying for a loan is to complete an application. The lender is looking at your social security, your date of birth, your work history. We will review your income. So typically, if you are salaried, we'll look at your pay stubs, but if you're self-employed, we will review your tax returns. Pretty basic stuff. We'll need 2 years of W-2s, and even if you have moved jobs, that does not present an issue. We would just need the W-2 from your previous employer and then your most recent bank statements. And when we're looking at your bank statements, the lender is reviewing if you have the funds towards down payment and savings after the down payment, and that is considered reserves. The bank is going to review and pull your credit. We do start with the soft credit pull so that it does not have any impact to your credit score. A good credit score is considered 720, but you can buy a house with a credit score of as little as 580. So 720 would be used for a conventional loan. But if your credit score is more marginal, there's other products that you can take advantage of, including an FHA loan. And we'll get into loan types later in our presentation. We will assess your ongoing monthly application. So if you are positioning yourself to purchase a property, it's really good to try and reduce your monthly obligations. So if you're in a position to pay off credit cards, that is recommended. Or if you have student loans, then you can get on an income-based repayment plan, which gives you the lowest monthly payment. That helps in reducing your debt to income ratio, which in result helps your buying power.
Brenda?
Yes.
Usually I recommend that people get in touch with you sooner rather than later. Just to make sure that they're not, maybe paying off things, as you had spoken earlier, that are better left alone. So, that's an idea as well, is really to kind of reach out to the lender first and plan your plot of attack from there.
That is correct. You do not want to start paying off old creditors without discussing it with your lender. So as part of the pre-approval process, we will analyze your credit score and go over any recommendations with you. So definitely talk with your lender in advance of any movement. It's totally fine to pay down credit cards, so that is not an issue. But if you have outstanding collections, sometimes if you pay off that collection, if it's older, it can hurt your score. So do speak with your lender in advance of doing so. Assets. It is a misnomer that you need 20% to purchase a home. While it does put you in great position to have 20% down, it is not required. You can purchase a property with as little as 3 to 5% down. And when we look at the research, the average down payment in 2022 was 6% down. So you don't have to have 20% down, but if you have 20% down, it does help you to avoid mortgage insurance, which is an additional cost associated with having a low down payment. Mortgage insurance is insurance that protects the lender in event of you defaulting on the loan. So it is an additional cost and something that I'll model later in our presentation. But there are lots of sources of funds for purchasing a home. Obviously, you can use your checking, savings, stock, or retirement. You can get gifts from family. If you already own property, you can take out equity in your existing property and use that as down payment, in addition to down payment assistance loans or grants that are available in the marketplace. You will need, in addition to your down payment, funds for closing costs. You can use those same sources to fund your closing costs, your savings, you can get a gift, or you can take advantage of down payment assistance programs. The size of your loan matters. So as we are analyzing your profile, we will discuss the different products, like a conforming loan, which is anything under 1.15, and then we'll talk about jumbo loans as well. Any questions? Okay. Feel free to put your questions in the chat. It's not necessary to wait to the end of the presentation. Income. When analyzing your financial profile, banks will want to see that you have a 2-year history of employment or education. The 2-year history does not have to be on the same job. You could have had multiple jobs. We will just look to see if it is in the same line of work. If you were recently in school and you just started your work history, the lender will use your education. So oftentimes we have recent graduates. So we'll just use your transcript as your 2-year history. And it's not even necessary that you've started your new job. We just need a signed offer letter from the company that you will be starting with within 60 days. See, actually we have a question in the chat. What about savings for supplementals? When you say supplementals, are you meaning
like fixed income? like Social Security, disability, things like that?
We can use that as towards your down payment, yes. Thank you for the question. And when it comes to your income, the lender will want to see that your earnings are consistent. So if you have bonus income, we'll take an average of that. If you have commission income, we will look at averages as well. But we just want to make sure that you receive the type of income consistently over a 2-year period. And if there's a change, sometimes we can use that. It just needs to make sense. So what happens is you write a letter of explanation. So for instance, oftentimes I have clients either go from self-employed to W-2 or vice versa. And if it makes sense and we can show proof that the income is expected to continue at the same level that you received over a 24-month history, we can submit the file to underwriting to have it reviewed to be used.
Brenda, I have a question. What about child support both ways? If you pay child support or you're receiving child support, how does that look?
If you're paying child support, we will deduct that from your income, so we consider that debt. And if you're receiving child support, it needs to continue for at least 3 years. So we will look at either the divorce decree or the child support agreement. And if that income is going to be continuing for 3 years, we can use it.
Thank you.
You're welcome. Any other questions on income or anything that we have covered thus far? Okay. So here I just highlighted a few down payment assistance programs. These are some of the more common assistance programs that I see. There are lots of different programs. So I'm going to start with sharing how you can find out about down payment assistance. First, think of or search the county that you're interested in. So for instance, if you're interested in purchasing a property in Alameda County, you can simply go to the Alameda County website. They typically have what's called a housing tab on the website, and it will speak to specific programs that are available in that county. Same thing for city. There are city-specific programs, and to learn more about the city-specific programs, you just go to that specific city that you're interested in, go to their website, and on their housing page, it will give you all of the criteria needed to learn more about those programs. The typical criteria that you will see for different down payment assistance programs include income-based. Most programs have income limits. While they all don't, not all programs have income limits, the majority of them do. You will look to see if they have credit score requirements. And then with the city programs, there are below market rate programs where you're able to purchase a property at below market rate. So meaning the property could have a true value of $700,000, but because the city has dedicated affordable housing tracts, they may sell you that property for less than the market value. And typically with those programs, they're looking at the number of occupants in your home. They have stipulations around that. And then they do have income limits. Typically, they want you to be under the area median income. So the median income for that specific county. So for Alameda County, I believe it's 100% of the area median is 189,000. So you will look at the criteria of the different programs to see which one you meet. Now, as part of our pre-approval process, when we are reviewing your file and you're interested in down payment assistance, we will do that homework for you. The CalHAPA program is a state program. So it has, you may have heard about Dream for All. It was all over the news in 2023. Well, that program is coming back. We don't have the specific criteria of the Dream for All program, but we do expect that it will be released in the spring and that there will be a lottery. The nice thing about CalHAFA, I've used it for years. Actually, when I bought my first home in my 20s, I took advantage of the CalHAFA down payment assistance program. I like it because it has very generous income limits. Typically, you can make up to $300,000 and still take advantage of this program. When you go on their website, the income limits are there. And the income limits differ per county. So look at the county that you're interested in purchasing in and check out the income limit for that specific county. So CalHAFA has the Dream for All program, but in addition to that, they have other programs that will give you up to 6.5% assistance. So if you think about it, you're buying a house, we have programs that only require 3% down. So you can get the 3% down plus have another 3.5 available to you for closing costs. So I've used this program where folks have had less than $2,000 out of pocket. So it's great. One thing about a lot of assistance programs is the interest rate on most assistance programs is higher than the market. So there is a cost because it is a loan, it's not a grant. So we can go over that in detail if it's something that you specifically are interested in, but I just wanted to make you aware that the interest rates on most down payment assistance programs are higher than the market rate. Home Run, I like this program. It is a census tract program. There's no mortgage insurance, and you can do as little as 1% down, and it does not have an income limit. The Shanoa is an FHA program, which offers 100% financing and requires a 660 credit score. The Daisy and Grow program, you can purchase a home with as little as 1% down. It does have an income limit, and I believe it's the area median income limit of the county. The Cal Home program is another great down payment assistance program specific to residents or employees of Oakland, where you can get up to $200,000 in assistance. Now, this program, because it's so popular and they give so much money, which helps to either reduce your monthly payment or to increase your buying power, it often runs out of money quickly, typically by late summer. So if you are actively searching for a home and you meet the criteria of the Cal Home program, it's something that you will want to take advantage of early in the year while they still have funds. And when I last looked, I believe it was funded at 1.5 million. So definitely, let's talk if that's something that you want to consider. And then the final down payment assistance program that I will share is Golden State Finance Agency. I do quite a bit of these as well, and they offer up to 7% assistance, so you can essentially get into a home with no out-of-pocket costs. It has generous income limits as well. Any questions before I move on from down payment assistance?
Yes, I have a question. This is Carla.
Okay.
I'm wondering about, say, the Cal Home must live or work in Oakland. That's also to purchase a property still in Oakland, or
Correct.
it could be anywhere in Alameda County.
Thank you for that clarification, because that is an important item to note. It is specific to the city of Oakland. So you would have to be buying in Oakland as well. You can't live and work in Oakland and take the funds elsewhere. You would need to take advantage of purchasing in Oakland. Any other questions?
I do have another question.
Yeah.
So my other question would be, say you working, went through a home buyers program and you have this certificate. What does that certificate, I went through Richmond Neighborhood Housing program, and I guess they're in association with Oakland. How does that apply when working with you all?
So that is a great, Richmond Neighborhood of Housing is the key resource for assistance. So it's great that you took advantage and you did the education component. Most of the assistance programs do have an education requirement, and so you would have completed that. So if you were taking advantage of CalHAFA, the education that they do at the Richmond Housing program does satisfy that. I believe there's a timeline of a year. We can double check that. But so
Yeah.
your education that you've completed would satisfy the education requirement for most programs.
Yeah, they said it's a year, except if you continue to work with them, call them, that sort of thing. They extend your certificate out, and they won't begin that process of your certificate until you're ready to purchase a home, as long as you are working with them.
Oh, that's great to hear. We will be sending some follow-up information after our Zoom, and so we'll include information on the different assistance programs that are available. I wanted to give you a sample scenario. So Brenda, the borrower, has a credit score of 700, 725, and 740. As you may know, lenders pull your credit score from all three bureaus. So we're going to look at TransUnion, Experian, and Equifax. It is my recommendation that you monitor your credit score. My favorite is Experian mobile app. The reason why it's important that you monitor your score is so that you can see how your activity impacts your score. By getting the information directly from the source, the bureaus, it'll give you recommendations on what you can do to increase your credit score. So if you go on to Experian, it will also tell you what your credit score is for the different vendor types. So there's a different modeling system or scoring system for purchasing a car as opposed to getting a mortgage or a credit card. And so when you are using Experian mobile app, it will show you your score for each vendor. And you want to have that information so that when you go to apply for credit, you already have an expectation of what the score will be that the creditor will see. And so in this scenario, we have scores of 700, 725, and 740. The lender is going to always use the middle score. So in our scenario here, we're going to use the 725. And then we see that our borrower has debt of like 500, because we're going to take your credit card debt, your monthly payment. Oftentimes, folks think that we're going to use the balance. We look at your monthly payment. So you could have, $1 million balance, but if your monthly payment is, for instance, you're on an income-based plan, and sometimes on an income-based plan, clients only have 0% they have a $0 payment. We will use that. If they have a $10 payment, we'll use whatever is reporting either on your credit report, or with student loans, we'll use the letter provided by the creditor. So when assessing your credit, again, we want to talk about any past due collections before you pay them off. And then we'll look at derogatory items. Oftentimes when working with clients, especially credit challenged clients, they may work with a third party a credit repair company. And what happens is you dispute items on your credit report. Well, when we go to do your pre-approval, those items need to be removed. The lender requires that all disputes be removed. And why that's important is because when you dispute something, it suppresses that from being added into the credit scoring algorithm. So that item is not calculated until that dispute is resolved. And so most recently, I had a client whose credit was like in the 500. She wanted to buy a house immediately. We talked about where the score needed to be for the type of house that she wanted. And then a week later, she called me back and she's like, Brenda, my credit score is now 680. Well, when we looked, it's yes, because she disputed everything. So all of the derogatories were now taken out of that model. Well, we talked and I shared with her that you have to remove the disputes before you get into contract. We run it through to confirm that that is what the lender's looking for. We have like some automated systems that confirm what's required, and oftentimes disputes have to be removed. So I just wanted to let you know that if you do have disputes, that those will need to be resolved before you get into contract. And of course, paying down your credit card balances to below 30% of your total credit limit always helps to boost your score. So this particular borrower makes $120,000 annually, which is $10,000 a month. Most programs will allow your debt to income ratio to be at least 50%. So in this case, we take the $10,000 in income. We can use half of that towards all expenses. So we have like $5,000 to work with. We subtract the $500 that we know that Brenda has in debt. And so $4,500 can go towards your housing expense. So basically the math on that is you take whatever your monthly income is and just divide it by 2. That half of your income needs to cover all of your debt, the car payment, credit cards, student loans, and the proposed housing expense. So oftentimes clients wonder, how do we get to the debt to income ratio that we're calculating? It's because you can use half of your monthly income. And so assuming that this client wants to buy a $500,000 house with 10% down, it's a condo. So they have HOA dues of $300 a month in Oakland. So modeling that, they have a $450,000 loan. Interest rates have improved a bit, which is great. And so what goes into your monthly payment when you buy a house? You have your principal and interest. You have your property taxes, which are assessed based upon your purchase price. You have homeowners insurance. In this instance, because the borrower only put 10% down, they will have that mortgage insurance that I mentioned earlier, and then HOA dues. So the out-of-pocket on this purchase is $4,000 a month. So when we get you pre-approved, we show you what your total housing expense will be, and we can work with you to model different purchase price so that we can get your budget consistent with where you want it to be. And the factors on that housing expense are here. So in this instance, if you wanted to lower your housing expense, you can do so by increasing your down payment, or you can adjust your purchase price. So that is where your lender will work with you to determine a target purchase price consistent with your monthly budget. So does she qualify? This is the housing expense. This is her monthly debt. This was the income. So the debt to income ratio is 45%. yes, the borrower qualifies. How much do they need to buy this $500,000 condo with 10% down and roughly 10,000 in closing costs? They need to be prepared to bring in 60,000. 60,000 at close of escrow. So again, this is just a high level review to give you an idea of what factors go into your pre-approval. And we will model something specific to you consistent with the factors of your financial scenario. Ebony?
Yes. Hi. Contingencies. So contingencies, there's 3 contingencies in a contract that are the buyer's protections. There are the outs for the buyer. In a normal market, everyone keeps them. In a competitive market like we had in COVID, you saw buyers giving up some of their contingencies in order for them to win, pretty much for the sellers to accept their offer. So their following contingencies are inspection contingencies, which is the physical location inspections mainly, but also could include your condo review and eligibility for insurance and zoning and permit review. You have your loan contingency, which some of you work with your lender. We get the release from lender saying it's okay, your loan is good. This is something lender can give you a counsel on. We try to get each client to be able to write a non-contingent on a loan. In other words, fully pre-underwritten file, but nothing is guaranteed until the loan is actually closes. And then you have your appraisal contingencies. And this way you may have some negotiation, because if the property doesn't come back at the asking price that is listed, then you can actually negotiate for the actual price, right? Because your lender is not going to approve you for a loan for a house that doesn't meet that's actually priced at that what the actual seller wants from it. So for instance, say the house is 500,000, the appraisal come back, the home is 450. The lender's not going to give you a loan for 500,000 when a house appraised at 450. You would get that loan for 450, or whatnot. And let's see, natural appraisal conditions up. And the appraisal basics. What it is. Appraisal is an independent inspection that determines fair market value based on recent sales of a similar property in the area. Additionally, it confirms property size and conditions that are no health and safety issues, provides additional info about the neighborhood, zoning, and market conditions. Who is it for? It's mainly for the lender, and to a lesser extent, the buyer. Brenda?
Yes. So basically your appraisal is ordered by the lender. You cannot choose your appraisal. There are laws against that. So you may know, hey, I have a family member who's an appraiser. Can they do the appraisal on my transaction? No, it has to be an independent third-party appraiser selected by the lender. The cost associated with an appraisal is roughly $600 to $900, depending upon the complexity of the report and the square footage, things like that. Appraisers will have a copy of your contract, so they will know what you have offered. And 90% of the time or greater, I really don't have a lot of appraisal issues, but to the point that Ebony made earlier, there are contingencies that are part of your standard contract that protect you. So in the event that your appraisal comes in short, your agent and your lender will discuss what your options are. But basically the appraiser is confirming the value of your property. If for some reason there is a low appraisal, you can restructure your financing or you can bring in the difference. And here we have seller concessions. When you, oh, go ahead, Ebony.
No, it's fine. You're good.
Okay. So as you're working with your realtor on the negotiations, your agent will give you guidance regarding if you can ask for a concession, which is typically a credit that can be applied towards your transaction. Ebony, you want to talk a little bit about that?
So, okay, there are only two costs when you purchase a home, the down payment, closing costs. So the payment must come from the buyer, gift approved or a down payment assistance program, and it can't be credited by the seller. So in asking for a concession, it can be a myriad of things you ask for a concession on that can actually go towards some of the closing costs and everything. It really depends on the property and what's happening within the contract.
Thank you.
You're welcome.
So if there was a market where you were able to negotiate a seller concession. So meaning, for instance, you're buying a house for $1 million and the seller, for some reason was unable to move the house, or working with your agent, something came up in inspection. So you were able to get, to say, for instance, a $30,000 credit. If the seller gives you money towards your transaction, it cannot be applied towards the down payment. It can only be applied towards your closing costs. You can also negotiate a price reduction. This is where your realtor is always going to give you guidance. But we just wanted to let you know that in some instances, you can negotiate funds to offset the costs associated with your purchase. That concludes our presentation. Any questions?
And feel free to unmute yourself.
I have another question. This is Carla again regarding supplementals. Like when you purchase a property, somebody didn't had that property since, however long. But the purchase price that you purchased the home at, and then the cost that they originally purchased the home at, that sometimes there's a supplemental cost that comes after the purchase of a home, which I think that some people aren't necessarily prepared for a lot of times. Can you tell me more about that? Can supplementals be taken at another time during the purchase of the property, or?
So you're talking about the supplemental tax bill?
Yes.
Yes, so correct. What happens is when you purchase a property, the taxes are reassessed based upon your purchase price. So say, for instance, you're buying a house and the person has owned that property for 25 years. So because they purchased their property so long ago, they could be paying $2,000 a year in taxes. Well, when you go to buy that property, your tax rate is going to be based upon your purchase price. If you purchase that price for $1 million, it's likely that your tax bases will be assessed based upon your purchase price. So your tax bill is going to increase. It takes the county assessor a little bit of time to update their records and reflect the change in ownership. And so sometimes, depending upon when you purchase and the date when taxes are due, a tax bill can go out without the full reassessment. It's not uncommon for that to happen. So when you buy your property, you're going to know all your costs. You're going to know what your property tax bill will be. Your lender will provide that, and also your escrow company will provide that. So that supplemental bill, while delayed, is not a surprise. So you know the amount that you need to put up to be prepared for that supplemental bill, but it has been disclosed in your loan documents and again in your escrow closing statement what your property tax bill will be. The delay is just due to the date between your purchase price and when the tax bill was assessed, but it's typically not a surprise.
Any other questions? The slides will be made available to you all and within 24 to 48 hours, along with additional resources and contact information for Brenda and myself. So if you want to hang back, if you have questions that you don't want all ears to hear, you may hang back. And everyone else, I guess we can conclude, unless you have something you want to say, Brenda.
I just want to thank everyone for taking time out of your day today to join us and learning about home ownership. It is the first step, right? It's a new year. As you are planning your goals for the new year, if it includes home ownership, definitely schedule time with Ebony and myself, and we will show you how we can help make it happen for you.
Again, thank you all for coming. And like I said before, if anyone wants to hang back because I have questions or want to talk to Brenda or myself, please do. If not, we are concluding this session, and I will see you again in 2 months. Thank you.
And feel free to follow us on Instagram. You'll see here where you can find Ebony at Realtor_Ebony Smith. And then I am at the Wyatt team.
I always forget that social media.
Yes. Oh, thank you for the hand clap,
Thank
Nathan.
you. Thank you all. Thank you. And we can stop recording.
I have one more question
Yes.
about when can we set up some time to start kind of assessing where I am, what I need to do. Right now I'm working